Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention. It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome to the Greedy Trader channel. Well, I'm not exactly greedy, as most of you old watchers of the channel will testify. I have the most conservative approach to trading. It's just a nice parody idea from the Gordon Gekko mantra. There are only 2 kinds of traders, the greedy ones and the fearful ones.
Greed, for lack of a better word, is good. Greed is right. Greed works.
Those of you who are new to the channel, this is where you can learn how to really trade like a professional. Every video I make is packed with real examples with before and after scenarios, so you can see that it is simply a question of sticking with the plan and not changing it because you're having an emotional meltdown. In this video, I'm going to explain to you what TPO chart is and why as a trader you should be using TPO charts at the very least to qualify every trade you make. As always, I'm not going to waste time. Let's get straight into the video. What is TPO charting? TPO is short for time price opportunity. You may also hear TPO referred to as market profile. If you've not watched my video on what is market profile, then now will be a good time to bookmark it and watch it straight after this one. So what does time price opportunity mean? Let me explain. Markets are effectively auctions. Buyers want to buy the lowest bid and sellers want to sell the highest offer. Depending on the overall interest in the asset being traded, sellers will be able to achieve their price or buyers will achieve their price. If the market spends a lot of time filling offers from sellers to buyers, then we can assume that there's a lot of demand for the asset, and this is reflected by the time the market is spent at the highest offers. This is the time part of the equation. By the same token, if buyers are willing to pay the offer, then we expect that future sales will be done at higher prices. If this is not happening, then we can assume that at the very least, the number of buyers are equal to sellers. This is keeping price steady. In other words, prices are fair or trading a fair value in this particular auction period. This is the price part of the equation. I hope I have not lost you. If I have, no worries, here comes an example. Let's take the SPX or S&P 500 daily profile, a daily collection of TPOs represented as letters. These don't have to be letters. They could be blocks or anything else you want them to be. Peter Stiglmaier, the creator of the TPO chart, thought it was a good idea to make them letters. If you want me to do a video on who Peter Stiglmaier is and his impact on floor trading, let me know in the comments below. Now back to the example. You can see that when TPOs are collapsed, they form bell curve shapes representing the total distribution of price within the specific day. We can quickly tell where the market spent the most time by thickness or bulge in the profile. The longer the line of TPOs horizontally, the less price movement there was at the time. This is a super cool observation, the sort of depth that most traders can only dream of visualizing if you're using just candlestick charts. In this example, we have one major bulge in distribution and price closed above the bulge. So what does this mean? Since price is higher than the bulge, then the bulge has to be buyers achieving bid prices. In other words, absorbing all sellers and eventually pushing prices higher as demand exceeds supply. So the opportunity lies in buying because the market spent the most time filling bids and price moved higher, extending the range. This is why Stiglmaier called it time price opportunity charting. So a TPO in essence is one letter representing a unit of price movement. For example, in a 1-hour auction of the S&P 500, let's say A period, each A print represents a quarter increment of price change. So for example, if price moved from 5400 spot 00 to 5400 spot 25, then we have the TPO letter A, since we are in the first hour of trading. Once that first hour is complete, we will move to B period and start to print Bs. It's pretty simple. So what does a TPO chart tell you that a regular candlestick chart can't? Well, it's a question of how much market depth you can see. If you want to see just basic high-low close price data, in other words, a snapshot, then candlesticks are perfect. This kind of data rarely gives you information on the best prices to place bids or offers. There isn't enough data depth to do this. This means your error rate will be higher.
Whoopsie daisy!
especially if you're trading with leverage. On the other hand, if you have a TPO chart, you have a lot more market depth. You can visualize volume by observing the bulges in the TPO chart. This extra depth will help you with trade location. If you've been following so far, or you're a genius, you would have noticed that the daily profile is actually a daily candlestick, and the TPOs are telling you what price did in that profile period. So you have enough depth to see where each side was most active, giving you execution reference points. This is represented by what happened the next day in our example. You can see in S period, the price auctioned lower into the bids from the previous day and then rebounded off that price area and ran straight up to the offers from 2 days prior and then auctioned back down again. The savvy trader with this depth information would naturally place orders in and around the bulges in the profile. This additional information would not be available on a candlestick chart. It will be healthy to remember that successful trading is not about being extra smart. The most successful traders are never the smartest. They are the traders with the most market depth. Professional traders within market making institutions have book depth, transaction data from credit and debit card purchases, and margin data from bank deposits. So with all this information, how can they lose money?
Fucking genius!
So if you can build a trading tool stack based on how much market depth you want to achieve, then your trading will get more successful over time. So ask yourself, like Morpheus asked Neo in The Matrix,
Do you believe that my being stronger or faster has anything to do with my muscles in this place? You think that's air you're breathing now?
that scene is my favorite scene because it personifies losing traders in a nutshell. To my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?